Fubo TV is currently sitting at exactly $3.54. The market is closed, having finished the last session with a slight upward nudge of 0.43%, and in the pre-market hours, we are seeing a further tick up to $3.55. If you're looking at the chart right now, you might just see a low single-digit stock chopping around in a tight range, but if you look closer, you are witnessing the absolute calm before a structural storm. The expectation for Fubo has long been that it was a dead man walking, a small, capital-intensive streaming service destined to be crushed by the tech giants and their massive sports joint ventures. That was the narrative for years. The reality, however, is completely different and significantly more complex. We are not watching a company dying. We are watching a company in the middle of one of the most aggressive strategic pivots in the streaming industry, fighting a multi-front war that involves antitrust litigation, a massive merger with Disney's Hulu Live TV assets, and a fundamental shift in how Wall Street values subscriber growth versus profitability. If you think this is just another penny stock gambling chip, you're missing the entire picture of what is happening in the boardrooms of New York and Burbank right now. Let's look at the immediate price action because the tape tells a very specific story today. That close at $3.54 is not random. Over the last 5 trading sessions, we have seen Fubo bounce repeatedly off the $3.40 level. This level has established itself as a hardened floor of support where institutional accumulation seems to be stepping in every time retail investors get spooked and sell. The volume we saw in the last session, just under the average, suggests that the sellers are exhausted. When volume dries up on a pullback or a consolidation phase, it typically indicates that everyone who wanted to sell has already sold, leaving the stock in the hands of stronger, long-term holders who are waiting for the next catalyst. We are seeing the price compress. The Bollinger Bands on the daily chart are tightening, and usually, when volatility compresses this much, it is followed by an explosive move. The direction of that move depends entirely on how the market digests the ongoing integration updates with Disney, but the technicals are screaming that a breakout is imminent. You cannot look at this chart and see a flat line. You have to see a coiled spring. The biggest driver here, and the thing that separates the casual observers from the serious analysts, is the context of the Disney deal. Late in 2025, the landscape shifted when the news broke about the combination of Fubo with Disney's Hulu Plus Live TV business. This effectively killed the bankruptcy thesis that short sellers had been feasting on for 3 years. The bear case used to be simple. Fubo burns cash, Fubo has no leverage, Fubo goes to zero. That thesis is now incinerated. With Disney taking a controlling 70% stake, the capitalization risk is largely off the table. However, this creates a new confusing reality for the stock price, which is why we are stuck at $3.54 and not $10. The market is now trying to price in merger arbitrage risk and the future value of the minority stake that public shareholders will retain. Investors are asking, what is my 30% worth in a Disney-controlled entity? This uncertainty is capping the upside for now, but it also puts a concrete floor under the stock because the bankruptcy risk premium is gone. We need to discuss the financials because the most recent third-quarter earnings report was a genuine shock to the system for the critics. Expectation was another quarter of heavy losses and cash burn. Reality? Fubo posted its second consecutive quarter of positive adjusted EBITDA. Do you understand how significant that is? For a growth stage streaming company that operates on thin margins due to expensive sports rights, hitting positive EBITDA twice in a row is the holy grail. It proves the business model actually works. Revenue came in at $368 million, which was a slight dip, but the earnings per share beat expectations significantly, coming in at a loss of 6 cents versus the expected 9 cents. They are getting more efficient. They are cutting marketing spend while still growing subscribers in North America to 1.63 million. This tells us that the churn problem, where customers leave after football season, is being managed much better than in the past. The company is maturing from a growth-at-all-costs startup into a disciplined operator, and that transition is usually when the stock price starts to stabilize and base for a long-term run. Now I want to address the short sellers because they are still here and they are still dangerous. Despite the Disney news, short interest remains elevated, hovering around 16% of the float. Why? Because there is a new bearish theory emerging. The new bear thesis is that Disney will eventually squeeze out the minority shareholders at a low price, essentially taking the company private on the cheap. Short sellers are betting that the stock will bleed out slowly as enthusiasm wanes and the complex integration with Hulu drags on. They are paying high borrow fees to hold these positions, which indicates a high level of conviction. However, this is a risky game for them. If Fubo announces faster than expected synergies, or if the Department of Justice puts favorable conditions on the merger that protect minority shareholders, we could see a massive short squeeze. The days-to-cover ratio is creeping up, meaning if a rally starts, it will take the shorts days of buying to exit their positions, which fuels the fire. You need to watch the borrow rates closely. If you see a sudden spike in the cost to borrow Fubo shares, it often precedes a violent upward move as shorts rush for the exit. Speaking of the merger, let's talk about the legal side. The settlement of the Venue Sports lawsuit was a masterstroke. Fubo walked away with $220 million in cash and a $145 million loan commitment. This injection of liquidity is the bridge they needed to get to the closing of the Disney deal without diluting shareholders further. This is what the market is currently underappreciating. That cash on the balance sheet changes the enterprise value calculation. When you subtract the cash from the market cap, the actual valuation of the operating business is incredibly low relative to its revenue. You are paying a bargain basement multiple for a company that is about to become the 6th largest pay TV operator in the United States. The expectations are so low that any good news regarding the regulatory approval of the deal could send the stock significantly higher. It is crucial to understand the product itself. Fubo is not just Netflix with sports, it is a cable replacement. In an economy where people are cutting the cord to save money, Fubo actually offers a value proposition that is sticky. Their multi-view technology, which allows you to watch 4 games at once, is still superior to what you get on YouTube TV or Hulu standalone. This product superiority is why they have been able to maintain pricing power even as they raised subscription fees. They are passing on the costs of the sports rights to the consumer, and the consumer is staying. This demonstrates brand loyalty and pricing power, 2 things that Warren Buffett would love even if he would never touch a stock this volatile. The stickiness of the subscriber base is the hidden asset here that does not show up on the balance sheet but provides the safety net for the revenue projections. I want to pause here and get your take on this massive shift. Do you think Disney taking control saves Fubo, or do you think it kills the independent spirit of the company and hurts the product? Comment below, saved by the mouse or independent forever, because this is the biggest debate in the media sector right now. The consolidation of media is inevitable, but whether it is good for the consumer and the shareholder is a completely different question. Let's get back to the retail sentiment because it is fascinating. If you go on X or Reddit, the Fubo community is one of the most resilient I have ever seen. They view this stock as a battleground against the monopolies of traditional cable and big tech. There is a strong David versus Goliath mentality at play, even though David just partnered with Disney. This retail base provides a level of liquidity and support that other small-cap stocks do not have. When the stock dips, they buy. When the shorts attack, they hold. This emotional attachment to the stock creates a floor. It is not just about the numbers for them, it's about the mission of sports-first streaming. But as an investor, you have to separate the emotion from the data. The data says this is a high-risk, high-reward play on regulatory approval and merger integration. There is a macro angle here too. The advertising market has been soft for the last year due to economic uncertainty, but we are seeing green shoots of recovery in ad spend for 2026. Fubo generates a significant portion of its revenue from advertising. As the economy stabilizes and brands start spending again, Fubo's ad inventory, which is highly valuable because it targets live sports viewers who can't skip commercials, will become more expensive. This acts as a lever for their margins. A 10% increase in ad rates flows almost directly to the bottom line. If the ad market rebounds in the first half of 2026 while the merger is closing, Fubo's numbers could look drastically better than the current analyst estimates, which would force a repricing of the stock. We also need to monitor the institutional ownership changes. In the last quarter, we saw some interesting rotations. Vanguard and BlackRock maintained their positions, which is standard for index funds, but we saw some hedge funds trimming while others added. This rotation suggests that the smart money is divided. Some are taking profits after the merger announcement pop, while others are positioning for the long-term synergies. When institutions are divided, it creates volatility, which explains the chopping action we are seeing between 350 and 380. You want to watch the 13F filings closely next quarter to see if the arbitrage funds are stepping in. If you see merger arb funds buying, it means they are confident the deal closes. If they stay away, it suggests regulatory risk. Another risk factor to consider is the technical debt. Streaming is expensive. You need servers, bandwidth, and engineers. By merging with Hulu's tech stack, Fubo should theoretically be able to slash these costs. This is the synergy buzzword you hear, but in this case, it's real. If they can migrate Fubo's backend to Disney's infrastructure, the cost savings could be in the hundreds of millions annually. That turns a break-even business into a cash cow. However, tech migrations are notoriously difficult and prone to failure. If the app becomes buggy or crashes during the Super Bowl, the brand damage would be immense. This execution risk is real and should not be ignored. Let's look deeper into the options market. The open interest on the $4 calls for